In the last fiscal year, India's UPI network processed over 300 lakh crore rupees, with hundreds of millions of transactions occurring every single day. The system now facilitates the vast majority of commerce across the country. In 2020, the Indian government introduced a specific legal mandate. They ordered that all transactions running on the Unified Payments Interface, as well as domestic RuPay debit cards, would be exempt from merchant discount rate charges. The practical: if a customer paid 1000 rupees, the merchant received exactly 1000 rupees. Because no banking intermediary took a cut, small vendors could accept digital payments without losing their profit margins to transaction fees. There is a specific irony in this infrastructure. While the network itself is Indian, roughly 80% of the transaction volume flows through applications owned by American corporations, specifically Google Pay and Walmart's PhonePe. Despite controlling the primary apps that Indians use every day, these foreign companies have been legally blocked from extracting any processing fees from this massive flow of capital. That legal protection is now being dismantled. The Indian Parliament recently introduced the Taxation and Other Laws Bill, legislation that removes the specific rules that kept the UPI network free of merchant fees. The timing of this shift aligns with a report from the United States government, which officially labeled India's payment architecture a hostile trade barrier. It suggests the decision to end free UPI may be tied more to diplomatic friction with Washington than to domestic economic policy. To understand the tension between New Delhi and Washington, you have to look at the traditional infrastructure of legacy, debit, and credit cards. Whenever money travels from a customer to a merchant on these legacy networks, it encounters a series of middlemen who each slice off a small percentage known as the merchant discount rate. This toll is divided into three parts: an interchange fee for the bank, a processing fee for the terminal, and a network fee. This last cut goes directly to companies like Visa and Mastercard to maintain the security of the financial highway. Before UPI, US companies extracted over 100 crore rupees annually from these fees within India. When the government mandated a free, parallel system, that revenue stream disappeared. Friction increased when India allowed its domestic RuPay credit cards to integrate with the UPI network, letting users spend on credit without relying on foreign card infrastructure. Because foreign credit cards were excluded from this integration, Visa and MasterCard lobbied the US government, arguing that New Delhi was engaging in deliberate economic discrimination. To Washington, the rapid spread of UPI represents a direct challenge to American financial dominance. By removing the need for US based intermediaries, the system dismantles the global monopoly held by traditional credit and debit networks. This corporate lobbying has become federal policy. The United States Trade Representative has officially designated India's payment network as a barrier to international trade. India is not the only nation facing this pressure. Washington has a history of targeting countries that attempt to secure their own digital financial borders. In Brazil, the government built a domestic payment network called PIX, designed to offer low cost, secure transactions that bypassed American intermediaries. The US responded with the threat of 25. Similar patterns of diplomatic and economic pressure have been documented in Indonesia, Vietnam, and across the Gulf nations. This pressure now weighs on current US India negotiations. The two nations are currently bargaining over access to India's dairy and automobile markets. The United States uses these unrelated trade sectors as leverage, pushing foreign nations to reopen their digital borders to American financial toll booths in exchange for trade deals. In New Delhi, the cost of maintaining the UPI network is mounting. The government's subsidy budget, used to keep the system running, is reaching its 2000 crore limit. As a result, experts expect the introduction of new fees, with predicted merchant discount rates between 0.05% and 0.07% on UPI transactions. The government maintains that these charges will only target high volume merchants, leaving the average consumer unaffected. However, businesses operating on thin margins rarely absorb new costs. If a vendor is charged a processing fee, they are likely to recover that cost by increasing the price of their goods. The Global Trade Research Initiative has warned that giving in to US pressure on UPI sets a precedent that could compromise India's future digital sovereignty. A system built and subsidized to democratize finance for low income citizens is now functioning as a bargaining chip in a broader trade dispute. Geopolitical decisions eventually reach the individual. If international pressure forces the Indian government to charge the merchant, the merchant will inevitably pass that cost directly into the price of your groceries.